I've just
All
flipped
right.
my phone on silent.
Oh, great. Well, we're live now. Actually, that's a good point. I haven't put my phone on silent yet. I'll do that now.
Because every time that there could be a worse time, that's when it'll happen. Oh,
yeah, that's right. Okay, so people are starting to arrive in the room now. To those of you who are here already, welcome. This is our webinar on 3 key changes to the retentions regime. My name is Fraser May. I'm from Civil Contractors New Zealand. I'm the Communications and Advocacy Manager. And with me today, I have Stuart Robertson from Dentons, and he's a partner, and Victoria Bortsova, who is also from Dentons, and she's a solicitor. Welcome. Just while we're waiting for people to arrive in the room, we'll give it a few moments. I'll just let those who have already arrived know that there is a chat function on the right-hand side of this this webinar platform. So if you click where it's got the 2 speech bubbles and it says chat, then you can ask any questions you might have. And we do encourage you to ask questions as well. We're going to try and keep this session to a bit of a quick fire session so that we can get through what the major significant changes are for contractors. And then we can shoot through to a bit of Q&A at the end. Hopefully we can answer all your questions as well. But if we can't, then I think it's really good to have them so that we can respond to them afterwards. We've also uploaded a handout. So that's in the files, a little paperclip icon on the right-hand side. And if you go to that, then you can download the flyer that Dentons kindly put together for members around the key changes. So we'll just give it 30 seconds or so more for people to arrive in the room, and then we'll kick on. For those of you who have just arrived, Fraser May from CCNZ here. With me, I have Stuart Robertson from Dentons and Victoria Bortsova. Am I pronouncing that right? Is it Bortsova?
Yes, that's right. Yeah.
Okay, great. Who are going to take us through the technical details today after I go into a bit of ancient history. And once more, there's a chat function on the right-hand side. Please ask any questions you may have. I think it's, as I say, we're trying to keep this quick fire, so let's get into it. Today's webinar is on 3 key changes to the retentions regime. There is a recent law change. Some of the changes come into force on 5th of October, which is not very long away. It's just over a week. So we're going to let you know some of the details of what you need to get onto. I thought I'd just start with a little bit of ancient history here. I assume that most of the people on this call will know at least something about retention money, which is the amount that's held back to subcontractors from payments made to them under construction contracts as security for their performance by the head contractor or the client. That's probably a little bit more detailed than that, but that's a basic description. Now, the Construction Contracts Act was amended in March 2017 to protect retention monies, but there were some loopholes in that scheme, which meant that some retentions weren't protected as they should have been. It's not all retentions got repaid to subcontractors. Some got considered unsecured creditors. It's not ideal. So those loopholes have been closed in the latest iteration. So that's what we're here to run you through today. CCNZ advocated really strongly for those loopholes to be closed because obviously people missing out on their money when someone goes under from insolvency when they're a subcontractor, that party is not great. So that photo on the right-hand side is there is a former Chief Executive, Peter Silcock of Civil Contractors New Zealand, presenting his select committee alongside Brendan Cash from Dentons. Now, these legislative changes have been in the works for quite some time. That select committee hearing was way back in 2021, and we've been waiting ever since. So actually the changes are here now. So we've been waiting for these for a long time. So it's a little bit of ancient history, but as I say, quick fire session, let's get into what the real changes are. And so I'm going to hand over to Stuart now, who's going to run us through the really essential things that contractors need to know. Before you do, Stuart, if I could just ask people that are here, please make use of that chat function. It will really help us if we can know any gaps that you're not aware of around the retentions regime and around the new changes, and any support that you might need from CCNZ. There's also the 15 minutes free legal advice service that Dentons offer to CCNZ members that you can access through our website. So or by contacting your regional manager. So on that note, I'm just going to pass it over to you, Stu. Please go ahead.
Thanks very much, Fraser. Hi, everybody. This is a follow-on from the CCNZ annual conference where we held a session that was, you could hardly fit any more people in the room. And so after we'd done a couple of articles earlier in the year, one late last year, we thought we'd do this webinar as a sort of final update for you. But there will be, as Fraser said, material available through the this webinar function, and further information through the CCNZ website. So Victoria and I thought, let's focus on the 3 key changes. There's a lot of detail in the Amendment Act, but we'll stick to the 3, and we've split the task up for you so you don't get bored listening to me. I'm going to cover off the separate bank account requirement. There's reporting requirements, which I'll also cover, and then I'll hand over to Victoria, who's going to do what could be a bit of a sort of a scary part of the amendments if you're a Party A. And I'm assuming everybody knows Party A is the payer under the contract. So it could be the principal, could be the head contractor, and Party B is the payee, the one making the payment claims, receiving the money. So you're a subby or even a head contractor. And head contractors, you've got to listen extra careful because you're in both roles. Right, let's click over to the next slide, Fraser. What we thought we would do is we would identify for you what the issue was. The issue with the retentions regime that was currently in place, and then tell you how the amendments go to fix that issue. So on the separate bank account or complying instrument provisions, the real issue was the separate bank account. What was actually happening, even though people knew and know today that you're holding retentions on trust for Party B, and while you can put it in a bank account with other funds in your business, you can't commingle those funds as working capital. Now, that's difficult to actually separate in practice, but what was happening was that Party A's were just continuing to do what they've always done, which was to use retentions as part of the float, part of the working capital float. Where that comes unstuck is, as Fraser mentioned, is when Party A goes into receivership or liquidation. The receivers and liquidators have a heck of a time trying to work out, to trace where the retentions went, and if Party A hasn't kept very good records, and that was most experience, then Party B's retentions were lost. They're weighed down the liquidation list in the 7th schedule, and you've got preferential creditors like IRD employees and secured creditors before you even get a look at it. So unfortunately, on top of all that, the eBert case came along in the High Court, and it was because the receivers of eBert didn't know what to do with retentions, and unfortunately the judge decided that there was no trust created by the CCA, even though that's what it says, and deferred to the old common law principles of how you create a trust. Hence the trigger for these amendments to make it clear that you don't have to go through that process. There is an express statutory trust. So we'll identify the issues and then we'll tell you the solutions. Let's click on Fraser and let's look at the solutions here. So if you're retaining money partly or wholly for your retentions, then you've got to open a separate bank account. There is no commingling of retention money with anything else but retention money. You've got to open the account with a registered bank, and you've also got to tell the bank that it is a retentions trust account under the Act. If, however, you are doing in part or in full the retentions, protecting it by way of a complying instrument, and we've given you a couple of examples there. So you might choose to do it by way of a bond, by a bank guarantee, or an insurance policy. Then the amended Act makes it clear you've got to go to a licensed insurer or a registered bank, or as set out in regulations. Now, Victoria and I will mention regulations as we go. There aren't any regulations at the moment. So licensed insurer or registered bank. And you have to have a complying instrument for the amount equivalent to the retention sum in the contract. That means the whole of the retention sum. And if it's 3910 standard provisions, that's pretty straightforward. It's capped at 200,000. However, that can be changed, and you could also be working under the CCA standard subcontract agreement or another form of subcontract agreement, and you'd have to be careful to allow for variations if there isn't a cap, price escalation, time-related cost, all of those other factors that adjust the contract price up. You'll have to anticipate that if you're putting in place a complying instrument. Next one, Fraser, thank you.
Just to remind people that they can ask questions, we do actually have one question, so I think we might as well tackle that now. Question, where do retentions sit in the guarantee process? Is it IRD first, bank, then retentions? Or
very good question. This is obviously when you're talking about there's two scenarios. If it's party A who's got your money and they go into liquidation, 7th Schedule of the Company Act gives priority to creditors. And of course, IRD are not quite at the top, but they're high up. The trick here is it's not party A's money. And the amendments have strengthened this to make it very clear it's actually your money as party B. So the receivers don't get it, the liquidators don't get it, because it is not party A's money. If, however, you, party B, are in trouble, got a receiver appointed or liquidated, you're under a liquidation, then the receiver liquidators can ask party A to, when it comes time to release the retentions, say, we want that. That is money coming into your accounts, and therefore it goes through the ordinary ranked secured creditors.
Great. Thanks for that. Thanks. And I think really important point. I mean, it is actually party B's money. So, I think that is the message that we've been trying to get across through all of the advocacy. Sorry to interrupt.
I see another question, but we'll actually answer it. We'll answer it shortly.
We'll try and cover the rest at the end. I just thought we'd get people used to asking questions, so please ask away. Great.
So, second section that I'm going to cover for you, the second of the big three. Reporting requirements and record keeping. So they're actually two separate concepts here, and we'll split them up in a minute. So anecdotally, what we've been finding is that notwithstanding the current statutory requirement says that there must be financial records kept, and on request, on you as a party B requesting that information, party A has to cough it up. They're not. Party A's are not keeping the required financial records. And on 4 occasions, I think now I've assisted CCNZ members through the 15-minute advice. And we created on the members-only area in the website a template letter for you to use requesting from Party A that information. They just haven't replied. And the real kicker here is that under the current Act, there's no way to enforce Party A to meet its obligations to do either of those things. So let's move on to the next slide. So what's the solution? Well, overall, it's to strengthen and better define the obligations, the reporting and record keeping. And for record keeping generally, you have to have what records that are appropriate, having regard to the amount of retention money and the circumstances of the case. Now, that could be difficult. There might be a bit of arguments around that, but take the two extremes. If we take a small contractor down in, say, the Waikato, doing under $1 million turnover a year, then there will be a different level of requirement of record keeping than there would be to one of our large ones. And the ones, the sort of McDowell's, the Fulton Hogans, Fletcher's Hebs, those sort of down a size companies, they will be expected to have quite a sophisticated record keeping system. So flexibility, which is appropriate. It's got to include, your record keeping has got to include all information required by regulations. There aren't any. Kept in a specified way in the regulations, that's still to come. But importantly, repeating again, that they have to be made available to Party B to inspect at a reasonable time and without charge. So that's just record keeping generally. Next slide. Thanks, Fraser. What about if you're keeping the money in a bank account? So your records have to identify that bank account, identify the construction contract, include all details of payments in and out of that account, so essentially a statement ledger system. If funds from other parties B are held in the same account, record that fact. If there are multiple party B's retentions held in the account, there's a whole lot of additional requirements. So I'll just pause there, Fraser, because we've had another question. Can retentions be held in a group bank account? Now, if not commingling with working capital of the entity deducting. Okay, so the second part is definitely can't commingle with working capital. It's got to be purely for retentions. A single party A can have one bank account that has multiple party B's retentions in them, as long as they're running a ledger system that each ledger details in those funds which party B has the retentions. You imagine a trust account with lawyers. We have a single trust account, but we have thousands of clients, and we run a massive ledger system. All right, I'll come back to the group bank account thing. Fraser, don't let me forget that later on. All right, let's move on to the next solution the amendments provide. And next slide. Thanks, Fraser. And this is if you've got record keeping for complying instruments. You've got to keep a record of all of the copy of all complying instruments. It may sound crazy, but why wouldn't you? You know, you would expect, but people weren't. For each of those instruments, you have a record of party B's interest, including the protected amount, because a complying instrument may cover several party B's. If the issuer of that instrument limits their liability, you've got to be transparent, and you have to tell party B what that limitation is. You have to have evidence you've fully paid up any premium or money owing to have that complying instrument. You've also, interestingly, got to record any failure to comply with the instrument's terms and conditions. And that's a bit like the consumer provisions in the Building Act, where builders have to tell their clients if they've been in trouble under the Building Act before. Well, you can now assess if there's been any breaches of the complying instruments T&Cs. And if, same as before, if you've got multiple party Bs involved in a single complying instrument, there's a whole lot of additional requirements. All right, thanks, Fraser. Let's move on to, that was the record keeping section. Reporting requirements. The solution is that an initial report must be given by party A to party B as soon as practicable after the sum becomes retention money, and at a minimum a further report every 3 months until the retention trust comes to an end. And that trust comes to an end, as you'd ordinarily expect, is once you've got to final completion, or you've done some sort of deal on a final account where you might release part or all of the retentions in a certain way. So no magic about that second requirement. But there is an interpretation argument here, and that's why we highly recommend just get into the habit of reporting as part of your payment schedule every month what is required for your reporting requirements for retention money. That way you'll never get caught out of missing the 3 months, or the argument being that if each retention amount is a fresh deduction, which it is, then you might, one interpretation is that you have to do an initial report every month anyway. Just do it as a standard part of your payment certificate, payment schedule information is our recommendation. Sorry about that though, everyone. That's going to be another level of admin and paperwork, but if you get into the habit of doing it monthly, you won't miss out. Next slide, thanks, Fraser. So what is that information? It's fairly straightforward. There's no real magic to it. The total amount of money held, identify the contract in question, the date of retention, the date you retain money, details of the bank account or the complying instrument, or both if you're splitting it, And a statement, importantly here, like with the CCA adjudication stuff and your Form 1 for payment claims, a statement of Party B's right to inspect Party A's accounts and records. So it is more onerous if you're a Party A. It's great if you're a Party B, and it's a marked improvement on what was there before. Now, I think this is where, you want to move on to the next slide, Fraser? Yes, this is the scary bit, so I'm going to hand over to Victoria.
Thank you, Stuart. Good afternoon, everyone. So I will be talking about the introduction of fines and penalties, and this is another very significant change that's been brought about by the Amendment Act. So as we know, before the amendments, a party could make a complaint about breaches of the retention trust. It could write letters to the principal, who is the Party A, seeking evidence that retentions are being held on trust as required. However, if no response was received from Party A, then effectively Party B had no actual rights under the Act to do anything about this. And the Act was essentially deficient in that sense, as it didn't give, or I guess incentivize Party A to comply with the Act, and there were no sanctions imposed. So now, as we will see, there are extra penalties for breaches of the Amendment Act. And as you can see on the slides, there are essentially two regimes which the Amendment Act provisions apply. And the first one is to do with Party A failing to keep retention money on trust in a separate bank account or providing a compliant instrument under Section 18D. And the second
Next
one
slide,
is...
Fraser.
Yeah, thank you. And the second one is to do where Party A fails to keep proper accounting records and financial records of the retention money, and that's under Section 18FC. And separate from that, if it doesn't provide regular reporting or make those records available to Party B on request. So starting off with the first regime, where Party A fails to keep retentions as required, as Stuart already mentioned, it is now mandatory to hold retentions as cash in a separate bank account in a registered New Zealand bank, or unless there is a compliant instrument in place, for example, a bond. So as we can see from the slides, if Party A fails to comply with this, under Section 18DA, Party A is now liable to a fine not exceeding $200,000 for each offence that's been committed. And in the case of where Party A is a company, you can see also that each of its director or directors also commit an offence, and they are also liable for a fine that won't exceed $50,000 for each offence committed. And this is really important to know because the Act previously didn't provide any consequences for directors for failing to comply with the provisions, and now there are really significant consequences for breaches. So moving on to defences, there's broadly three defences that I'll mention. So the first one is where Party A can prove that it took all reasonable steps to ensure that it complied with this section. And the second one is where the defendant is director. They can also prove that they took all reasonable steps to ensure that Party A complied with the section. And the third defence is if the defendant can prove that they acted in good faith, or they honestly and reasonably believed that the use of retentions was permitted. And this is essentially where they believe that retention money could be used to remedy defects in performance of Party B's obligations under the contract. Next slide, please. So moving on to the second regime, and this is where Party A fails to keep proper records and fails to provide regular reporting. So sections 18FC and 18FD. So as Stuart already mentioned, Party A must keep accounting records of all retention money held for Party B, and it must also provide regular reporting to Party B. So as we can see on the slides, if Party A fails to keep proper accounting records, there is a maximum fine of $15,000, $50 for each offence. And the similar is also for breaching of regular reporting requirements. So there's also a maximum fine of $50,000 for each offence committed. And interesting to note that there are no consequences for directors where the Party A is a company, and this needs to be contrasted to there being liability for directors if they fail to keep retention money as required, so Section 18D that we saw earlier. And there are also no defences available for these breaches. So just to note enforcement and assessment, New sections 18M and 18Q have been introduced in the Amendment Act, and these assign the Chief Executive of MBAE the role of assessing and enforcing breaches of the retentions regime. Next slide, please. So when does this all take effect? So the changes will apply to all new contracts that have been entered into after 5th of October 2023, and also to all existing contracts that have been renewed after 5th October 2023. And I think this brings us to the end of the slides, Fraser.
Yeah, great. Well, thanks, team. Look, I think we've got some really good questions out of this as well. So, look, thanks to all who are here, and let's keep them coming, because if we don't get time to address them today, it gives us some really good understanding of what we need to be providing with the industry, so everyone kind of come to terms with these changes. So, time to kick on to question time. I think, look, some really key points from my perspective. Retentions aren't the money of Party A, so that's something that we've been pushing for more recognition of, and some of the changes kind of deal with that. Some of the questions, let's start off with the more recent ones, and we'll work our way back, I think. So first off, what are proper accounting records? Is this defined somewhere?
Well, actually, not in the CCA, no. But they are a recognised term under some of the accountancy rules and financial reporting rules through companies. So the best advice is to go to your accountant and ask them what are proper accounting records for my operation, whether it's a small, medium or large enterprise, and get your guidance from them.
Okay. What does renewed mean in this context? Sorry, we might have to go back a slide or two to figure that out.
So that was interesting. We won't identify who's posting the questions, but good question. We actually just talked to Fraser about it before we went live. Imagine you have a 3+1+1 contract, and you're coming to the end of year 3, and in November you have a right of renewal. Then if you renew, then the retentions that you may be holding for the 3-year part of the contract are under the old regime, but any renewed contract, any retentions under that after 5 October, then are subject to the new regime. So, yep.
No, that makes sense, I guess, in context. And so it only applies to historic contracts, but largely only applies to historic contracts if they are renewed.
That's right. Yeah. So in a way, you have got a little bit of leeway. Imagine you enter into a new contract on the 6th of October. That's the first sort of operable date. Then it's going to be a month's worth of work if they get established immediately. Then you've got your 17 working days to assess, issue your schedule under 3910, this is, and then make payment. You're well into the second month. So it is a progression. It's only for new contracts after the 5th of October, or renewed contracts, and only for the renewed part. So it's not all going to drop dead for you on the 5th of October. There will be a little buffer.
Right, really good question, I think, here. By each offence, does that mean one account can have 10 different subbies retentions, and that then 10 fines if there is a penalty applied? Or would it just be one penalty for the one account with 10 different subbies in it?
What do you reckon, Victoria?
I think it would apply probably to just one. No, correct me if I'm wrong, Stu. But
I mean, it'll apply to every breach. So if the bank account that they're holding the 10 subbies retentions in is simply not a complying bank account, it's part of their working capital account, then they've actually breached it 10 times. The amendment regime, the retentions regime under the amendments, is per contract. So you might only have one Party B. If you're a Party A, you only might have one Party B, but you might have 10 separate projects where they're working for you. Well, they're 10 separate contracts, that's 10 separate obligations. So depending on that structure, yes, you could either 1 or 10 breaches.
Okay, and the question here, I think we've good to get some detail on this one. I think we have addressed it in part, but if Party A fails to keep retentions as required and goes insolvent or into administration, where does Party B sit?
Well, this is one of the brilliant things following EBIRT, which was messy, is these amendments make it very clear the money, the retention money, your Party B retention money was never Party A's money. Hence why it's in a separate bank account, hence why it's protected. It doesn't go in to the general liquidation administration funds. It's your money, it's sitting separately for you.
Exactly, and that's the point we've been trying to make on this one for years now. So, yeah, I think that's really good to answer that. Bit of a general question about assessment of the quantum of retention monies held by and for the industry and research of the impact on it. I think that's probably a general question rather than a legal one necessarily. Can you have a stab at it, Stu?
Yeah, look, there has been some research and some that we were involved in. The difficulty is it's very much putting a finger in the sort of wind, licking your finger. One estimate came up at 3.5 billion. Is the current pool of retentions that are out there. But there was an assumption made that was at 10%. So somebody looked at the infrastructure spend in New Zealand and applied 10%. We all know that very rarely is it 10%. It's normally 7.5% to 5%, somewhere around that level. But it's still nevertheless a fair number, and it'll be sitting in the banks' accounts. And there's a related question is, well, is it entitled to earn interest, and does the interest have to be reported on? Mm-hmm. Yes, it does. It can earn interest, and I would encourage you to think about that. An interest-bearing account for your retentions account with your bank. The interest actually belongs to Party A. They get to keep the interest, and because of that, it's not actually your money. That it's not retention money. It's earnings from retention. So in my view, you wouldn't have to report the interest earned in that monthly reporting to Party B.
Interesting. Question that's probably dear to my heart here. Do you have templated spreadsheets for recording retentions that you could share? I'm sure we can whip something up. What do you think, Stu?
Well, probably not us. We wouldn't be the best ones to do it, but we can talk to the CCNZ's accountants or talk to your own. But a spreadsheet would be, for an SME, I would have thought a properly crafted spreadsheet would go a long way to meeting the requirements. But again, this is an accounting question. You should be talk to your accountant about.
Yeah, no, look, we'll look into that for you. I guess another question. Does this mean that interest? Oh, you've just answered the question on interest getting paid to Party B. That's good. You've also answered the question: does this have to be a separate report, or can it be information on a payment certificate? My understanding from what your presentation said is that information on a payment certificate is fine.
Just have it as a schedule that accompanies it every month. Yep.
Great. Question here. Every time a company pays a dividend, directors have to be confident the company is solvent. Does the money held in the retentions account add to the company's position, given that a significant proportion of the retentions are not due until the expiry? Well, they're not that company's money would be my take on it. Is that right, Stu?
Yeah, we're straying again out of legal into accounting, but for Party A, it's not their money. So you'd have to ask your accountant, well, if it's not our money and we're simply a bare trustee, which that's very clear they are now, then does it form part of their assets? I don't see how it could. It's part of Party B's assets. The question is more, I think, pertinent is, as Party B, talk to your accountant as to whether you have to actually note as an asset, albeit contingent on you completing your obligations under the contract, can you count that as an asset or earnings or revenue coming in? So yeah, that's a very good question, and talk to your accountant. Yeah.
This is great. Look, so are you okay if we cap this at 4:40? I guess we were supposed to finish 3 minutes ago, but I mean, look, there's some great questions coming through.
Why don't we, Fraser? Why don't we grab some of those questions that anybody's got? If they're not answered already, we might be able to collaborate, Fraser, on a note in one of your e-newsletters, and we could answer a few of the ones that we haven't been able to live.
Yeah. What do you reckon? So can we go 2 or 3 more questions, do you think?
Oh no, we've probably cut it off now.
Cut it off now? Okay,
and,
cool.
and
we'll do an FAQ document. So keep the questions coming, team. Thanks so much for your time and raising the questions with us. We'll address them, and we'll send out a recording of the webinar, I think, and to those who've attended, and also we'll get onto those FAQs and we'll get those answers back to you as well. Also, if you need specific advice around your contract, friends at Dentons are here to help. We've got a 15 minutes free service available through CCNZ, so just either contact your regional manager or lodge your query on that one through the website. Right, I think it's time to wrap. So thank you very much for your time, Stuart and Victoria, today, and for all our attendees. I will keep that coming. The PDF detailing the new key changes for contractors is available through the little paperclip icon on the right hand side, so you click it to download it. Keep asking your questions to the chat function, we'll get onto them. And last off, just hope everyone has a good evening, and we'll catch you later.
Thanks everyone.
Thank you.
Thanks, Fraser.